The Federal Reserve met today. They left the rates unchanged. That was expected, but it seems like their policy may have softened, and there's long term implications about that. Well, we're going to talk about the Fed. What did they say today? What's different? We're going to see how did the market react, and what are the long term implications of their new stance? Well, today the Fed met and they left rates unchanged at current levels of 425 to 450. That was widely expected. Let's compare the statements from December to January. For the most part, are identical except for a couple excerpts. Inflation, they said in December, has made progress towards the committee's 2% objective, but remains somewhat elevated. Well, that has made progress has turned into inflation remains somewhat elevated. See, we're no longer making progress. Now inflation remains somewhat elevated. They said in December, since earlier in the year, labor market conditions have generally eased and the unemployment rate has moved up but remains low. Well, from generally easing, now they said the unemployment rate has stabilized at a low level in recent months and labor market conditions remain solid. So, why is this different? It appears as though the Fed is confident about the jobs market. They're satisfied at current levels, and they're more willing to accept inflation at current levels, I think mostly just because it's not moving anymore. Now, what was the market reaction to all this? Well, we can see here, these are the Fed funds futures. This is for the May meeting, by the way. This is the big meeting. We're going to show you in a minute why the May meeting is so crucial. And this is current rates 425 to 450. And what you'll notice is as of yesterday, we had a 49% chance the Federal Reserve would keep rates unchanged by May at current levels, 49. As of today, we jumped up to 58%. There's a much greater probability the Fed will not cut rates in May than what we thought yesterday. And we're going to show you in just a second, this is a significant jump. Let's take a look to see where the Fed funds futures plot our course. So we can see here the red histogram bar shows us a 4 to 425. That would represent a quarter point cut. In the March meeting, we have a 23% chance of a cut, 77% chance no cuts. That was March. In May, 47% chance of a cut, 53% chance no cuts. In June, now we go to a 2% chance of a half a point cut, or we'll be down half a point from where we are now, 375 to 40. And we have a 99% chance at this point that will be a quarter point lower. So essentially, what the Fed funds futures are telling us, most likely, at least according to what the numbers say now, Fed will not cut rates in May, and the first cut will be in June. And then after that, we have an 83% chance we'll only be down still a quarter point, 17% chance of a half a point. Now, how can this affect the stock market trend? Now, again, remember, we're at 49% chance of no cut yesterday in the May meeting, and that jumped up to 58% chance. Well, these are the Fed funds futures. It's a histogram bar, just a little bit of a longer term outlook. The yellow line shows us the S&P 500. And notice what happened in December. This is, I think, around December 10th or so. We had, several pieces of economic news, but the Fed funds futures jumped from a 31 to a 50% chance. And that indicates a 50% chance that we'll keep rates at the current level, 425 to 450. Well, notice what happened after the fact, almost immediately starting the next day. We had a pretty significant stock market rally from the 5,800 level, or a little bit above that, on the S&P 500, up to above 6,000 in just about a week's time or so, maybe 2 weeks. Another example of this happened in January. We had a 45% chance that the Federal Reserve would keep rates at current levels, 425 to 450. But within 2 trading days, that jumped up to 69% chance. We'll take a look to see what happened with the stock market after the fact. We rallied from 5,800 up to 6,100. Now, we know conventional wisdom tells us that when the Federal Reserve is less likely to cut rates, it'll put a strain on the market. But consider the other side of the coin. That very simply, because the Fed or the futures market guesses that the Fed's not going to cut rates, it's actually a positive signal in a sense that, the economy looks strong. The Fed's not in a panic. The jobs market looks good. We mention all this because, again, today we jumped from 49 up to a 58% chance by May the Fed will not cut interest rates. Will the stock market continue as it has two times in the past? That's left to be said. Everything with a market is context, but it'll be very interesting to see with three times the charm. Later on this week, we have gross domestic product and PCE, personal consumption expenditure. The GDP is on Thursday and the inflation numbers on Friday. And it all is certainly very important. Watch the Fed funds futures and also the 10-year Treasury bond for a reaction after the fact. We hope this has been helpful. We look forward to seeing you back soon.